Good morning and welcome to the LIONTRUST Asset Management PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to John Irons, CEO. Good morning to you, sir.
Good morning, everybody, and welcome to this presentation for LIONTRUST's final results the year ending 24. With me, I'm John Irons, Chief Executive. With me on my left is Vinny Abril, Chief Financial Officer, and Simon Hilby, our Marketing Director. Presentation today will cover a bit on the financials, a little bit on the background of LIONTRUST, and a bit of our strategy going forward. I think to put it in context, maybe a few comments at the start on sort of where we have been and where we get to. The background to LIONTRUST is very much specialist asset management business focused on active fund management. Founded 28 years ago. I became Chief Executive a little over 14 years ago. We've got offices in London, Luxembourg, and Edinburgh. As I said, we're a very experienced management team here. We have 8 different teams, very much focused on the areas that they invest in. Assets under management currently a little under 28 billion, and the market capitalisation of the business is a little over 400 million. If I say, base tenet behind LIONTRUST, try to keep the business model as simple as possible. If you've got a good, strong investment process, we try and create the environment for managers to be free to run the money they want to be able to add value to client portfolios. The importance of that ever more so as you get into larger organizations or with index funds, where money is, if you like, deployed on a market weight basis. It provides little opportunity for price discovery. Cash being allocated to holdings on the back of news, not in advance of good news. So we believe that if we can provide that freedom for the fund management teams and they have a strong, disciplined approach to that, we'll get the best results for our clients in the long run. The other side of that contract, very simply, is if they do that, we provide a route to market for the services. We'll talk a little bit later on about the strength of LIONTRUST brand. It's the third best recognised amongst the intermediary marketplace. 90% of our clients are in the retail space, and we have excellent distribution, which we'll go on to talk about. If I hand over to Vinay first of all, and he can go through these financials.
So we've got the financial slide. There's a lot of numbers there, but maybe I'll just pick up some of the highlights there. To show you how the business performed over the last 12 months to the end of March 24. If you look at our before we get on to the actual results, if you look at the cash position and the balance sheet. So LIONTRUST has a very strong balance sheet, no debt. We have £104 million of cash on our balance sheet, and we have a very strong capital position, surplus capital. As a regulated business, we're required to have a certain amount of regulatory capital, and for us, it's just under 23 million, and our surplus capital is just under 80 million. So the business is in strong financial health in terms of its balance sheet and its capital position. In terms of the results themselves for last year, if you look at revenues and you look at revenue margin, our revenues are down as AUM has come down. But one of the key metrics that we look at is our revenue margin. So that is effectively revenues divided by our assets under management. So that tells us, how much are we earning on the assets that we manage? And over the course of last year compared to the previous year, our revenue margin was reasonably stable. So it was at 62 basis points, so just 0.62%. And that is very, very similar. It's down slightly. The number for the previous year 62.48 basis points. So on rounding, it's unchanged, but it's down half a basis point. So, a very, very small reduction. And that should give you some reassurance that, we're not slashing fees. We're not, we're not sort of trying to sell our funds at below our average revenue margin. So it shows that the business is being able to maintain the revenue margin on its AUM without having to cut its fees, which should run well for the future. So it's a good, strong revenue margin. In terms of costs, we've also had a strong performance in the light of revenues coming down. And if you look at our costs, there's really two main elements to our costs: our people costs, staff costs, and other admin costs. So that's everything else that a fund management business does in terms of property, rent rates, marketing, administration, etc. So in terms of non-people costs, in an environment where it has been an inflationary environment in terms of the costs that we incur, where inflation has come down, it has been high during the course of the financial year. But our total admin costs, our non-people costs, was reasonably flat, so it's up just under 2%. So our non-people costs were strongly under control. In terms of staff costs, our staff costs come down just over 20%. Again, shows good discipline. We've seen our headcount come down as our revenues and AUMs come down, and also the way that we remunerate our fund managers. We have a revenue share arrangement with them. So for every pound of revenue that comes in for the team that manages funds, they get a portion of that revenue as remuneration. So we have a flexible cost base. So as our revenue has come down, our staff costs have come down, in particular our fund management costs. And what has that resulted in? That's resulted in an operating margin of 35.5% for the year. So that's a key metric for us, because that tells us how efficiently we're generating adjusted profit from the revenues that come in. And if you look across our peers in the asset management world in the UK, that's a very strong number. We're at the, may not be the best, but we're at the top end of operating margin compared to our peers. And that shows you that, we've got good control over our costs. Just to give you some context of that, last year was 35.5. The year before was just under 38%. So the operating margin has come down, and that's just part of the operational gearing, which just works in reverse as it works when we're growing. But it just shows that even though it has come down, it's only come down marginally, and it still shows that we're running a pretty efficient business. So that financial performance has led to the ultimate outcome is a dividend to shareholders. So we've maintained the dividend for the full year at 72p. So that's a third year that we're going to be paying out 72 pence dividend. It's covered by earnings, so it's 90% covered, so 1.1 times cover. And and that 72p is made up of final dividend, or a second interim dividend, which is effectively a final dividend of 50 pence per share, which will be paid to shareholders. We went ex-dividend yesterday. Today's a record date, and the dividend will be paid on the 9th of August. So overall, although it's been a tough year in terms of flows, and our AUM has come down, it has been, in the light of that, we've maintained our revenue margin. We've seen we've controlled our costs, and we've got one of the best operating margins amongst our peers. So that's sort of a high level summary of the financial performance for the business. So I'll hand over back to John.
Thanks, Vinny. So a little bit context background. I mean, as Vinny has said, conditions have been challenging over the last couple of years, and they remain challenging. But that sort of depressed demand, is cyclical, and that long-term view here too. If I drift back over the last couple of years, obviously we've seen interest rates go up, inflation return, geopolitical uncertainties, and very narrow performance in equity markets. And effectively, we went from very much years ago when we had strong inflows into the business, and if you like, a risk-on environment for investing, to a risk-off environment. The book of business that LionTrust operates is very much equity orientated, has a bias towards UK equities. Within that, has a bias towards mid-small cap. Big book of business in the sustainable arena, which is very much interest rate sensitive. So it goes to show us, even with a very strong brand and strong distribution franchise, if the investment products you have are not pertinent to where investor demand is, i.e. investors move away from risk on to risk off, it creates a very challenging environment and backdrop for us. So at the beginning of last year, we looked at an acquisition for GAM Asset Management. Ultimately, we were unsuccessful in that, but the purpose behind that acquisition was to broaden out our product range, our investment offering into products that were less correlated to the ones we had and offered wider investment choice, and also to develop a broader distribution franchise in Europe. We have a very good market share in the UK, and we were looking to broaden out our European distribution. As I mentioned, we were unsuccessful in that, and I suppose there were two things that come to mind from it. What did we lose? Well, obviously, primarily we lost 18 months of product development, and with the headlines that existed at the time, some reputational brand damage. The way that we monitor the brand and the external sources say that brand now is back to the position it was, if not slightly stronger than before. And in a moment, I'll talk about where, what we've done on the product development and making sure that the business is in as stronger position as possible, for future growth going forward. I think, having highlighted the challenging demands of, the rise in interest rates, where investors were getting compensated not to take risk, maybe not in real terms, but to stay away from volatility that we see in markets, and also a cost of living crisis, which saw more raids on people's savings and withdrawals from pensions. Obviously, two pulls against us, but I think it's important to look at, and we sit here this morning with the dawn of a new government, and the market's reaction to that has been, saying this may be slightly positive. But I think in the interactions I've had with the Labour policy side from Rachel Reeves, is very much a pro, business, pro growth environment. The fact that Labour now have a large majority will hopefully give some stability to the outlook. That's important given the very small percentage of the UK equity market that we own domestically. The UK government has less than 1% in UK equities there, and as a whole we own about 4%, so much lower levels than international marketplaces. To get economic growth, which is the forefront of, you get economic growth and investment, you get a bigger tax take. So, what does an asset manager do? We deploy the capital that allows the economy to function. And I've been encouraged from, comments I've got that, simplification of the pensions system, and encouragement to get more people to save. At present, the savings rate in the UK is only 8%. Even if it doubled to 16%, it would be somewhere behind the likes of Australia and the savings levels around the world. So the demographic is very much a driver and flows. I think the encouragement to drive savings towards the equity market is a tailwind, because without getting efficient public or private markets working, we won't get the economic growth that is there. I also see that, the UK market, and I'll talk a little bit about it later, is very cheap on a national basis. But international investors want to, of the turmoil that has existed, on the political front over the years, international investors have stayed away from the UK. And I think this period of stability will help bring us back. And I read a report this morning, which is a survey of wealth managers across the UK, who all see, I think it was something like 94% of them see the UK as offering good value. This is after a period where, outflows from UK equities, over the last 4 or 5 years have got us back to this very low level. And the de-equitization caused by sort of Truss and Quasi with their ambitious borrowing plans that led to further withdrawal. So I think a period of stability and some long-term planning is a favourable backdrop for the investment in it. I want to, have you got that slide there? Please. As Vinny said and touched on, not going on, we start with a strong platform, a strong basis. Investments in process, automation, centralization, outsourcing, i.e. the things that we want to do inside a LIONTRUST are the things we can add value on, i.e. the strength of the brand, the distribution, and the investment process. Everything else we need to have relationships with to make sure that not only do we offer the strongest and most robust services, but the most competitive ones. On the global equity side, we recently made a hire in Mark Horton. He's come with a Marshall Wace and background, and will bring a fund with him, but also will put in charge of 1.1 billion of our global equities teams. We had existing global equity franchise. We've got a very strong India fund and a Japanese fund, but we felt that in that space, there's 550 funds in the global space, and we needed to get a better categorization and delineation, for a better word, of our product offering. Mark brings with him, a team which is highly regarded, and over the first couple of months has integrated well into the business. But that, the global equity franchise is an area where we see we want to grow further. And that will sit alongside our global innovation team, which run one tech fund in the last year, an innovation fund, and a global dividend fund. So really a strengthening of the investment proposition there, looking for that next area, where we can grow significant assets in the business. The long-term performance, I can talk on a moment, but what we want, is well-articulated investment performance, processes with excellent long-term track records. We made changes in the sales side as well. I will touch on, but really, I suppose, post-COVID. And the back to work of, work from home, and most of the management team here are in 5 days a week, but obviously we do offer that kind of flexibility. I felt that maybe LIONTRUST had a bit of long COVID. There were a lot of things we were doing, that we were always doing. I just didn't think we were doing them to the standard that we should be doing. And I'll talk a little bit in a minute about how we've changed both the distribution in the UK and internationally. And finally, we are moving to Aladdin, a BlackRock technology for a front office sort of portfolio management and research centering system. So we'll have, state-of-the-art, information sharing and a management system that, combined with a very strong middle back office that we have, all outsourced to leading providers, either with the Bank of New York or through Aladdin, will enable us to have significant scalability, flexibility, and efficiency across the business, to go forward. Go on, Simon. I touched about the brand briefly, and I'm not going to read these points out, but it does show the levels of engagement and the fact that we're sort of unprompted advertising recall to investors is getting us back up to the level we needed. We are very much a client-centric business. I talked before about the change from defined benefit to defined contribution, where the individual takes control of their own pension products. So trust is one of the most important things with clients. Recognition, comfort, and that is why the brand, remains vitally important to us. And to have, our retail offering with a strong brand is key and crucial. There you go. On the distribution side, we had 2 sales teams in the UK, one covering more the multi-asset or broader part of the intermediary market and covering the top side. I felt that as the product suite developed within the company, that it was important to bring those 2 teams together to give us a level of consistency and targeting, an ability to use data and to support our clients in the best way. In changes at the top with bringing in Christian Cook. Christian had been with us for 6 or 7 years, and he has made some changes that are aimed there with our strategic partners and key areas of client servicing. And that's brought, if you like, a new energy, vigor, and consistency across that sales team. And again, there's data there just showing you where our level of engagement remains high with all clients. So even in a depressed flow environment, clients, you can provide as much activity or events or meetings for clients, but clients have to want to come and hear what our view is, and that very much remains true today. On the European side, we brought Jeremy Robertson to head up European distribution. We already had 5 people in Europe on the sales side, but it felt that international distribution was quite narrow, and we needed to broaden out the breadth of clients we spoke to. We launched a pan-European offshore fund 4 months ago. We've raised 200 million with that. It's on the back of our cash flow team, we run the European Dynamic Fund, which in 18 months has gone from around 400 million to 1.6, 1.7 billion. So it's won of awards in the last 3 years and has strong performance behind it. The key with launching a fund at 200 million in Europe and bringing in Michael Buckles and Jeremy Roberts is that at 200 million, we can go to a broader range of clients and to larger clients. So the likes of UBS would not put it into one of their model portfolios unless it was above 200 million in size. So achieving that threshold early on in the launch of a product provides a very good platform for us to grow. And we've seen how the growth of the UK fund has performed. The operating platform and very much that centralization and efficiencies, the control of the costs that Werner has talked about with, on the RAM, how it's linked to asset size as well. But a desire to create that platform that gives us that scalability to grow the business going forward and to be able to be confident to take on new teams and new businesses as we go forward. Here are, the 8 teams. The 2 biggest blocks of business, obviously, in sustainable and economic advantage, and also showing where the global innovation team, and that was at half of the size it was a year and a half ago, and adding in the new core global equities proposition as well. So really broadening out the funds that we can show. I want to pick up on small bit on performance. This very basic and simple chart here, but I think it captures the last 3 years well. This move from risk off to risk, or risk on to risk off. You can see through 22 and 23 the effect it had on performance, and there will be some drag in that, obviously, through the 3 and 5 year numbers. But very pleasing to see, as we see a thawing of risk off, we look for interest rates coming, maybe one as early as the end of August, but certainly looking at September, and that better investing environment for the companies that we invest in. I've highlighted, 2 big books of business. We said, the struggles with the UK market over the last 5 years, very much that equitization, with the change of government and liberalisation of pension laws and encouragement by local authority pension funds, particularly to invest back into the UK to help power that growth that will give us more economic prosperity as a nation. And it shows you there the very depressed level the UK equity market sits, certainly relative to US. And again, referencing the report, I think the Rathbones produced this morning, showing that over 9 out of 10 managers are looking at the UK for going forward over the next 1, 3, 5 years. It's important for us that even though showing the 4 funds that we have there, very much that focus on process, consistency. We are the building blocks for a lot of client portfolios. And so the clients invest in this, even if they maybe used 3 or 4 groups before, they've gone maybe to 2, or they've halved their weightings. We've managed to be kept in client portfolios. So those, if you like, pipes or routes to market are open for that. And if you look at the exceptional sort of long-term performance of the funds there, it is a very compelling proposition for clients looking to invest in all parts of the UK market, from small cap or micro cap through to large cap. The sustainable investment team, again, for every challenging period performance-wise, we're in 5 years, reflecting that interest rate sensitivity. But whilst you can talk about the ifs and whens of allocations back to the UK equity market, I still think investment in sustainable is very much more of a mega trend, and I think the recent sort of regulatory changes in Europe with the SFDR and the introduction of the FCA's sustainable classifications this month will provide an area of competitive advantage for us. A team which has got a plus 20-year track record and a very focused investment process, knows what it's doing, will help us to stand out, both with an intermediary market who is questioning about what are the implications of the changes, but also with a general public that will be allocating more money towards sustainable investment. And also at a time when you can see that groups in Europe moving backwards from SFDR 9 categories to 6 or 8, reflecting this. If we do not do exactly as it says on the tin, we are subject to regulatory fines. So really, if you like, clarifying out the greenwashing. So having an investment process that stands true to what it is key for us. And again, very pleasing to see an improvement in the short-term performance going forward there. So really, to summarise and to finish, there's a very good base to the business. The brand is strong. I think the distribution is there. I think the investment, the improving outlook and ability in the UK economy and the investment outlook is favourable for us. I think our job is to be, when the wind blows in that direction, for want of a better word, is to have as much sail up as possible. We have a phrase internally, which is always the relentless pursuit of the basics. So I think with a good, solid operating platform, a strong brand, a well-differentiated investment proposition, it puts us in a good place, especially having come through what, across the industry has been an incredibly challenging two-year environment. So at that point, I'm very happy to take questions or move on. But thank you very much for your time.
Yeah, thank
Perfect.
you.
Perfect. John, Vinay, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right corner of your screen. But just while the company take a few moments to read the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received questions both pre-submitted and throughout today's live presentation. And Simon, if I could just hand over to you just to read out those questions where appropriate to do so, I'll pick up from you at the end.
Just hold the analyst one.
Yeah, thank you. Just there's a number of questions. There's a few themes. So the first theme is about analysts and their kind of notes on LIONTRUST and a downgrade on LIONTRUST. Do you want to respond
to the analysts all the time? So.
No, I think we have 7 analysts who cover us. I think if you look at their notes, the majority are positive on the business. They highlight the concerns around flows. I think they note the improving performance. So so I think overall, if you look at the 7 who cover us, we have 4 of them have a buy rating, 2 are hold, and 1 is sell. So overall, a strong bias towards a buy. In terms of the downgrades, that is right. So the analysts have done a small downgrade to their numbers. I think it's one actually has upgraded slightly, so they were a little bit lower than where we ended up last year. But small downgrades, they're 1 to 3%, I think, across the board. So and I think that just reflects the flow outcome for last year and where we've ended up AUM wise. We gave an update of AUM on the 20th of June with our results, and there'll be a further trading update next week. So in light of that, there's a bit of mark to market. When you get your annual results out, there's always a realignment of numbers going forward as we give greater guidance and actual hard numbers on revenue margin and the like. So I think it's a caution from the analysts, which is taking into account the tough year of flows that we've had and looking forward into the next 3 years. So I think there's no and actually the reassuring part is that you have got 4 of the analysts who cover us with buy ratings.
So the next question kind of picks up on some of that in terms of the AUM. When will it start increasing? I know you're asked this quite a lot.
I think look at where we are. Obviously, $6 billion of outflows is a good position. It's roughly split down to about $1.5 billion a quarter, and guidance at the market at the moment about just a little shy of 900 probably. So there's been a turn down, and as in we have less on the outflow side, but still not necessarily we'd want to be. I think when I talked about the 2 big books of business, if I look at those flows, it was probably around 200 million a month coming out of the UK book of business. In the short term, those flows have outflow slowed more considerably, and I think the outlook, again, the reference points which you look for as to where people's attitude are, that valuation opportunity that exists, maybe the direction of travel. I think things like the British ISA, the quantum doesn't change anything, but the mood music around things probably does change. And I think therefore the attractiveness of the UK equity market comes more into play. So really, to get away from the outflows, or to get into inflows, first of all, we've got to manage that outflow position. So I think a combination of clients now being much happier with those levels, and when I say happier, not wanting to take the money lower, and now that it'll be more about the outlook going forward and what people allocate there. With the sustainable side, I think there'll be more clarity around the position with FCA regulations, more focus on the space. I think more money is more likely to be channeled to those areas. And again, very much interest rate sensitivity. So I can see the outlook on those books changing. And then again, the other side, we've had, against that, we've had, good growth, in a poor market with the European products that we have. And I think the efforts we've put, into the global equity side is there. If I look across the industry, it's pretty much a similar position. Maybe some of the groups that have a product suite, which is more, well, either one of two places, more in money market or positions have had, better flow profiles. But as that money that has been in those more defensive things begins to see, move more to that risk on environment, I think the suite of products that we have, provides opportunity there. And so, and you can see in some of the other groups where you've got more, if you like, risk on products, the more adventurous investor is investing in those areas. So I think I'm not looking for a dramatic change, but I certainly think as we go through the course this year, we will continue to see, good improvement in the flow profile. And certainly as we, go through the rest of the year into next year, market will start to anticipate us going into, to positive flows. Very much, if you look at an asset manager, the old adage is, they behave a bit like a warrant on the stock market. If the stock market is looking to perform well, the asset manager will perform well. If the outlook for the stock market is not good, it is a more challenging environment, for the asset manager. So I think a combination of stability, lowering interest rates, and a turn to more sustainable and better economic growth provides a good backdrop for the next 3 years.
Next question is about the dividend. Can it be maintained, particularly if the company stays in terms of where it is financially?
Yeah, I mean, I think we paid out. We're paying out 72 pence dividend for the year just gone. So 50 pence is going to be paid to shareholders who are on the register as of today, actually, end of today, on the 9th of August. And if you look at the analyst forecasts, they're normally a good guidance, and they're all 72 pence for this next 12 months. So for our year that ends March 25, and 72 be in the next 2 years as well. So the analysts are forecasting that. If you look at consensus numbers, so the average of all the analysts who cover us, the consensus is a little bit under. It's at just under 71p, so a little bit under our dividend, so it's uncovered. But when I talked about our financial position earlier, we have a strong balance sheet with over 100 million of cash. We are profitable on an adjusted basis. We generally profits every month, and even if you look at where the market thinks we are, that's roughly almost averaging 5 million a month of profit. So we are in a strong financial position. So even if our earnings dip a little bit below the dividend next year, with obviously the current financial year, the dividend is maintainable, and the board are very comfortable with the position that we're in. So you have seen other asset management companies, some of our peers, pay uncovered dividends, so pay a dividend that is slightly more than the earnings, the after-tax earnings that the company's generated. I think for us it's about outlook and confidence, and hopefully if you read our our results statement, you'll see we have confidence. Although it's been a tough time, and it's probably going to be another quarter or two tough flows, we are confident about the future. Our funds are, on the whole, showing an improving trend in terms of performance. The interest rate environment will hopefully start improving. I think there's no commentators talking about interest rates going up. It's going to be going down. So I think there's some confidence to be had for the future. So I think the dividend and the market think is strongly saying that the dividend will be maintained.
The final question is about the balance between organic growth and acquisitions, and our strategy in terms of that?
Yeah, our strategy, is very much, the things that myself, Simon, can affect on a day-to-day basis happen inside the four walls of this business. We have always said that organic growth is the most important to us. The growth, it is the growth going forward. The growth going forward will be from the things that we have, hence the changes and the better clarification on the global equity side and the positioning of the product suite. The other point there, though, is to, how do you broaden out the range of investment offerings you have or enhance the distribution opportunities that you have? Two ways to do that. One is to hire new teams. If you hire a new team, it takes 3 years to get a 3-year track record, and you pretty much have to nickel and dime it with all the clients before you can build a product up to a size where your larger clients will engage with you because of their fear of concentration of ownership within portfolios. So that brings in, if you like, the third opportunity, which is acquisitions, be it bigger or bolt-ons. There, what we're looking to do is we're not looking to buy things just to fill silos. We're looking to bring in a new skill set, either on the investment side or on the distribution side. So really, if you like, a fast forwarding of that grow your own side. And that's important when we went through with the new front office system and the strong back office system. Technology is our friend. It is not an expense. To be able to get scalability and flexibility to run a business, having an industry-leading margin enables us, when we do look at acquisitions, to take them on efficiently, quickly, and to get the values out of them. So, we always need to look at where the dynamics of the market are. We are very much a client-centric business, so we need to know what are clients invested in, what are they looking at. If we haven't got that skill set inside, we would look at the acquisition side. And I think, in product development, having very focused teams, as opposed to, if I was at BlackRock, I would have 800 fund managers behind me. If I wanted somebody to run a rates product for me, there would be managers there. Here, we've got very clear teams. We can do product extension. So a classic example of that would have been taking the small cap fund. As that got bigger, we had a redundant, if you like, investment capacity in the bottom end of the small cap. So we launched the micro cap fund to give us that product extension. So it's really, what I'm trying to do there is just put in context where we use them. We do look at very much from what does it give to us, what is it adding. Any acquisition we make, we're looking to grow and develop, taking it forward. But whilst they get the headlines more than anything else, the focus of the business is very much on the day job and the organic growth.
Great. Thank you, John. Thank you, Vinay. Alessandro, that concludes the questions.
Perfect. John, Vinay, Simon, thank you very much for answering those questions. You can. Of course, the company can review the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you their feedback, which I know is particularly important to the company, John, I was just wondering if you had a few closing comments.
Just to thank everybody for their time. We very much appreciate it, and we appreciate the support and investment that we have from people. So thank you very much.
Yeah, thank you very much. Thanks for your time.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of LIONTRUST Asset Management PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.
Thanks very much.
Thanks. Bye.